for this very important webinar on operating procedure of monetary policy under flexible inflation targeting.
For inviting me to speak on this operating procedure of monetary policy and impact of liquidity management on short-term and long-term interest rate. I will leave it for discussion. I will not talk about that because that falls under the there are two sides of monetary policy. One is monetary policy formulation, another is monetary policy implementation. Your operating procedure is completely different from that of monetary aggregate targeting. It is regime specific. For example, exchange rate targeting. When there is exchange rate targeting, so in order to defend the exchange rate, their operating procedure shall be, so the operating target under monetary targeting, it has become very old now. So when we are having monetary targeting, they are not very, inflation matters. Means inflation, they will target definitely. It is overriding objective of monetary policy. But at the same time, they have to take into account this growth objective as well. So inflation targeting regime. So we will not go deep into the history like your exchange rate targeting, monetary aggregate targeting. We will talk about liquidity management in the inflation targeting regime. And inflation targeting regime, other eclectic frameworks, this nominal GDP targeting, etc. So this is already there in the system. Otherwise, flexible inflation targeting cannot be a framework of monetary policy. So that is a deep and integrated financial market and monetary transmission through interest rates. Together with other channels, interest rate channel must be working. If interest rate channel is not working, probably inflation targeting is not a good framework of monetary policy. Inflation targeting used to face a big challenge. So most of the inflation targeting country, if you see, the food and energy, but in India, we were avoiding inflation targeting for quite some time because food and energy constituted more than 50% of our CPI basket. So anyway, we have already accepted the flexible inflation targeting free from fiscal dominance. So when we are talking about this, flexible inflation targeting, it is left to the RBI. Which instrument will it use to achieve this 4% inflation on an average? A Reserve Bank takes a call. Which instrument would it use to achieve its price stability or inflation targeting? Demand and supply will determine the exchange rate, and it is flexible. Why? Your capital account is open. If capital account is open, exchange rate will be flexible. It compromises with independent monetary policy. So independent monetary policy cannot be pursued if central banks used to defend a particular level of exchange rate. Fortunately, in India, your liquidity management about your own currency operation will not be very effective because purchase and sale is also done by dollar. Then well-functioning financial market will ensure transmission of monetary policy that we have already discussed. Actually, commercial banks require liquidity for their reserve requirement. They are not supposed to borrow from the call market or money market and lend in the credit market. There will be asset liability mismatch. That use of reserve requirement with averaging to absorb liquidity shocks of lower magnitude. Suppose liquidity shortage is there, so that averaging that will take care of short-term liquidity shocks to the commercial bank. That is for your liquidity adjustment facility. We use OMO type operation, not outright OMO purchase or sale of. Ideally, the participant in the bank should equilibrate their requirement from the market. It is the discretion of the central bank to bail out certain institution if they are in dire needs. That is different. But above this policy rate, in that case, they will fall back upon the central bank to borrow it. If there is a shortage, then they can borrow from the central bank under some, in India we call it marginal standing facility. Those things are lined up for discussion. That it is at a penal rate, that lender of last resort, that provision is there with RBI. That is entirely different. This is not under the liquidity adjustment facility. This is a special arrangement for the institution which is under run on deposit, etc. Well-defined communication policy of the central bank is put in place. So these are kind of consensus. But this consensus, during the global financial crisis, the central banks faced a kind of very awkward situation. Liquidity was not available. They were trying to inject liquidity not under OMO, outright purchase or sell kind of arrangement, means purchase government security and sell it. So central bank wanted to target the long-term interest rate. It's not evening out, the liquidity in the market. Major concern was financial stability and growth. And with now in the normal situation, you have to smooth out the short-term liquidity situation. Okay. And accordingly, our liquidity management or operating procedure has also undergone several changes. RBI implements monetary policy through liquidity management. This is a simple thing. Operating procedures are fine-tuned from time to time. We will go one by one. So it becomes difficult to fund your requirement. So funding liquidity, fair weather friend means if market liquidity is high for the instrument, funding becomes very easy. They move in tandem. So participant, they will fall back upon the central bank, look forward to liquidity, that is monetary and systemic liquidity. Now you develop term money market and to ensure financial stability. Or if you are pumping too much of liquidity, interest rate will collapse. So financial stability is also ultimate objective. And to develop the term money market and ensure financial stability is there. Or autonomous frictional factor responsible for shortage or surplus of liquidity, which is temporary in nature. And then central bank used to, so capital flows are lower than the current account deficit. If there is a capital flow which is lower than the current account deficit, central bank has to release foreign exchange. If you release foreign exchange, you mop up this. The opposite is true for surplus situation. When deposit growth is higher than the credit growth, so there is surplus liquidity in the system. If you reduce CRR, release liquidity, that can be used for lending to the corporate sector. Suppose you will sell foreign exchange, you can get this liquidity back, possible. But of late, after the global financial crisis, liquidity coverage ratio, NSFR, and capital account opening, etc. management, these things can also supplement to deal with the structural surplus or shortage of liquidity. Now, coming to frictional liquidity problem, higher currency in circulation. Now, opposite is true for surplus. Currency in circulation will come back to the bank. Government will spend. Government spend balance will come down, or government can borrow and spend. There is a surplus liquidity, a surplus foreign exchange reserve in the market. And so buildup of reserve by the central bank is inevitable to as absorption capacity of the economy was low. You are having say tight monetary policy, interest rate is hiked, and also used prudential regulation for restricting credit creation. Too much of liquidity, interest rate coming down, standing deposit facility, I will come little later. Now, if it is unremunerated reserve, suppose CRR you are raising, then commercial banks have to bear the burden. Your reverse repo deposit facility, whatever interest you are paying, RBI is bearing the burden. So burden now shared between banks and this changes in the operating procedure of monetary policy. And Urjit Patel committee report has devoted one chapter on this, operating procedure of monetary policy. We have to understand what was his idea. Means you are meeting the 100% of the requirement of the banks. When commercial banks wanted to avail some liquidity, RBI will give. Not flexible inflation targeting. So we are developing this mechanism of liquidity adjustment facility. We have introduced marginal standing facility and fully accommodate liquidity demand at a fixed rate repo. systemic liquidity is shortage or it is in a surplus, the assessment has to be done by RBI. Operating target should be 14-day repo rate in due course. The idea was that overnight rate, etc., let the market equilibrate. Let the stakeholders buy and sell their money. Money market should equilibrate in the marketplace. Reserve Bank will provide liquidity, can come on the way or compromise with the liquidity adjustment on a day-to-day basis. That's why system liquidity, it is better to keep the system in a small deficit mode. This argument can be contested if you are having accommodative monetary policy. Even till 2019, we were of the opinion that structural liquidity problems should be dealt with. There are two understanding. One is notice money, term money market. Transactions are few and far between. So longer term repo will probably help in developing the term money market. Okay. Then standing deposit facility to be operationalized of the RBI relates to money market operation of the previous day. Means commercial banks are not in a position to visualize what would be their liquidity requirement 7 days, 14 days down the line. That's why their participation in variable rate repo is not bad. But Reserve Bank wanted to penalize them that you lend to the MSME, you lend to the corporate sector. That's why your reverse repo rate was independently reduced. Now you are now having VRR, variable rate repo, variable rate reverse repo. They are the main tools of liquidity operation, and operating procedure is mostly discretionary in the hands of the central bank. They are using this. Commercial banks are not in a position to make assessment of the liquidity on a fortnightly basis because daily there is a lot of transaction taking place. Government balances are changing, capital inflow, outflow. They are not in a position to do that. So argument is that let us go for 7 days. You see the liquidity operation since November, neutral monetary policy. Under neutral monetary policy, keeping so much of excess liquidity in the system is not advisable because there is some outstanding operation, there is also daily operation, and on balance, there is a kind of surplus liquidity to the extent. So when there is surplus liquidity, interest rate will gravitate towards. So anyway, there is surplus liquidity in the system. And if you see this, weighted average call money rate, it was close to the marginal standing facility rate November to say January or so. From February onwards, we are cutting the rate. When we are cutting the rate, it was around the repo rate. Now there is surplus liquidity. From April onwards, there is surplus liquidity. It is close to the standing deposit facility rate. Close to the repo rate if they strictly follow the stance of monetary policy. If it is neutral monetary policy, some banks might be accommodating some customer, money might be going to the capital market. So this is excess liquidity is not good. The conclusion that is emerging, liquidity management in India has evolved over time. Objective of liquidity management is to anchor the operating target with the repo rate. Reserve Bank of India 2011, 14, 19 and 2025 monetary policy in India, a modern macroeconomic perspective, evaluating monetary policy operational framework, Jackson Hole Symposium, August 2016. It gives a very good treatment of the operating procedure of monetary policy in all these countries. That means mostly the Western countries and also other inflation targeting countries.
For that incredibly insightful and comprehensive presentation. So your deep expertise and clarity have provided us with a truly invaluable understanding of the operating procedure of monetary policy. So the presentation, he also specifically covered the technical aspects of monetary policy implementation, including repo rates, reverse repo operations, corridor systems, and the transition from fixed rate to variable rate operations in India's monetary framework.
Bhoi sir, your presentation is, as usual, very exhaustive and very comprehensive and very clear about the future trajectory of monetary policy, how it is going to pan out. I have three questions in dealing with the flexible inflation targeting framework, because we are going to complete 10 years by 2026. Taking 46% of the total weightage that we have, I think that also needs to be rejigged somewhere. Maybe economic survey of Ministry of Finance has flagged this issue many times, that the composition and the mix of the variables in the inflation computation, that needs to be revisited. That apart, whether there is any scope for, I don't think as a developing economy we can still, as a emerging economy, we can still have the scope of a fixed target like many of the Western countries that they have, as far as the inflation target is concerned. So is there any scope for reducing the band?
Hence, Reserve Bank will give loan to the commercial bank even for overnight at a fixed rate repo. Repo rate will be, that rate will be above the standing deposit facility rate, not 5.5, it will be 5 point, just below 5.5. They are rewarding the commercial bank. This is a cost that central bank would like to bear to mop up the excess liquidity from the system. Regarding that band of 4 plus minus 2, see, Reserve Bank has come out with not only operating procedure, but also review of framework of monetary policy. Framework that 4% inflation plus minus 2. Initially, it was 4%. After 5 years, government also continued this 4% plus minus 2. The second review is due. Government will ask RBI whether I would give 4% or 4% is not correct. We will think in terms of something else. Now, beyond 6%, inflation harms growth. But very recently, one study was published in Quantitative Journal of Economics. But the problem I am telling, India will continue to remain a fastest growing major economy for some time. So in this review, probably government will continue with 4 plus minus 2. Wider band will continue. But there is an argument, if not immediately, in the times to come, we have to reduce the band for monetary policy efficiency, marksmanship of monetary policy. We should not tolerate inflation beyond 5.5 because gradually economy will grow and to high rate of growth will continue for some time. After that, our inflation and global inflation should converge.
And we may have to move for fixed inflation rate.
There will be a compromise. This compromise means credibility of monetary inflation targeting will be compromised. People will start doubting that probably Reserve Bank is not in a position to maintain 4% inflation, because ultimately you have to be integrated to the world. Your inflation target probably will continue at 4% plus minus 2% in the March. Lendable resources will be there because credit growth is not there, deposit growth is there, there is no problem. Lendable resources are available. And for lendable,
anyhow, that is not within this.
no, why I am telling, for your lendable resources, don't depend on money market. Net stable funding ratio, operating procedure, treasury management, short-term liquidity management is understood, but it should not be used for lending.
Is proactively taking to have the monetary policy to be in line with its objective. A reduction in interest rate in the ensuing credit policy meeting. Whether the reduction in interest rate of 0.25 basis point or 0.5 basis point which has been brought about in the policy.
Inflation expectation is much below 4%. It will be, I will not be surprised if it is below 3%. When there is global scenario is not very much promising, better to provide support to the corporate sector by way of reducing the interest rate so that we can grow on the basis of our domestic demand and supply. Why external commercial borrowing has gone up? Because commercial banks have not adequately reduced this repo rate, lending rate. Now, incomplete. So the transmission of lending rate is incomplete so far as the lending rate is concerned. And when we reduce the rate, they will probably borrow from this domestic bank rather than borrow from abroad. They are not borrowing. Why they are not borrowing? They are mobilizing a lot of resources from the capital market directly. If repo rate has come down, lending rate should also be reduced. Of course, they are telling there is some term premium, risk premium. They are giving some excuses, but lending rate, some commercial bank have raised it. You are pursuing accommodative monetary policy, surplus liquidity, CRR cut, that created hell lot of a problem. It is compromising transmission. It is creating problem for some commercial banks to take a view that the Reserve Bank is not going to reduce the rate further.
When there are so many avenues to obtain liquidity, then what is the logic of giving this facility to banks, and that is to 16% of NDTL? If some bank has to avail this facility up to 16% of NDTL,
132%, hardly there is any bank which might be
yeah,
defaulting on liquidity coverage ratio. Your, I think the commercial banks are maintaining this liquidity coverage ratio more than 100, and it is well above 100, and therefore they are not really borrowing for the purpose of maintaining LCR. They are borrowing for their treasury management. Your treasury management is, if excess is there, you invest. If shortage is there, you borrow. While borrowing, if you are borrowing from marginal standing facility, you are a lethargic bank. Participate in repo, it will be somewhat less than marginal standing facility rate. That's why the Reserve Bank used to combine OMO as well as liquidity adjustment facility.
For your incredible insights, and thank you to our mentor Dr. Rao and Dr. Shri Subramaniam sir for their very engaging observations. So this was a truly valuable and enriching session. I request all of those who are attending for the first time or as a individual webinar basis to take up our membership